Alright guys, we are talking about stocks and stock market today. I'm just going to kind of fly through this because, to be honest, most likely you're just filling in the notes at this point if you haven't been already throughout the year in missing class. So here we go. This is actually pretty interesting. Did you know that you can own part of a company such as Apple or Instagram or Netflix? You can actually own a piece of that company. Stocks represent, let me move my face, ownership in a company. If a company decides to go public, they will sell stock, which means it's a portion of their company, and then the company will sell shares, which are pieces of their stocks, to investors or shareholders, which are people like you and me. Whomever owns 51% of the company makes the decisions for that company, and companies make sure not to sell more than 49% in stock. Because otherwise they would relinquish their decision-making abilities. Who are shareholders? Me, you, your mom, your dad, anybody, the everyday Joe, anyone who buys shares in a company. And then we own pieces of it. What is the stock market? Stock market is where shares in corporations are bought and sold. Kind of like a store. You can buy as many shares as you can afford. So as many pieces of a company as you can afford. Nope, that's not it. Or as many that are available. It's not unlimited, obviously, because companies only push out a certain amount of shares. So it used to be in old movies like Ferris Bueller's Day Off, or there's a couple of different things. They all would crowd in a room. It's called the Trading Pit. And there were screens everywhere. It's from Wall Street, New York City. There's the Chicago one where they all kind of gather together and they all scream and raise their hands and they're closing. And you've seen it. You probably didn't know what it was, but they're all like trading and buying and selling stocks. And that's how they used to do it with hand signals and all these crazy things. This YouTube video thing down here shows how it used to be. Until probably recently, like in the last 10 years. But now it's all done electronically. I'm sure it's less of a headache. Electronically. So you would just get a broker who would do it for you. The two main stock markets in the United States are the New York Stock Exchange and the NASDAQ. You may have heard these before, but not known what they were. If you really are interested in this and you want to look more into it, these are the top 4 foreign markets. The London Stock Exchange, Hong Kong, the Euronext, and the Deutsche Börse. You can look into that if you're interested in investing in foreign stock. Why would companies want to even sell their stocks? Well, there's a good reason for it. So a lot of times companies want to finance buildings, or they have projects that cost a lot of money and they don't want to borrow from the bank, because what happens when you borrow from the bank? Well, you have to pay back the bank, but you also have to pay back the bank interest. And who wants to pay that extra money? Nobody. So what companies do is they sell pieces or shares of their company, and instead of borrowing from the bank, they just get cash from their shareholders. And it's cash straight up, and they use that to finance the building, so they don't have to pay back anything extra to the bank for financing, which actually is pretty smart. So selling shares provides access to capital. Capital just means money. It's just a fancy word. Fancy. Usually in the form of cash. If a company needs to finance a major project, it can sell its shares to the market instead of borrowing money from the bank. This avoids paying the bank back interest, because honestly those projects would cost a ton of money, which means the interest would be like insane. But why would we as shareholders want to own a piece of a company? Because guess what? When a company does well, the value of the company increases and we make some money. The stock market provides a way to participate in a company's growth and also quickly convert shares into cash flow, baby. If the company does well, the stock may increase in value. Some companies may pay something called a dividend, which is a cut of their, this is me trying to talk and type at the same time. I'm actually doing pretty good. Dividend, where it cuts the company's profits to their shareholders. Some people actually get paid quarterly, which is 4 times a year, like pieces of a company, if their company is doing well or just staying steady. However, in the same token, if a company doesn't do well, the stock may decrease in value, which means we lose money, and sometimes it depends on how risky your investment is. You can lose it all, which is very similar to gambling, so you have to really be careful. Can we own as many shares in a company as we want? And how does a company determine the cost of each share? Great questions, Judy and Floyd. You can pay for as many as you can afford and as many that are available. The cost of a share is found by the company's worth. So obviously, Amazon is worth a lot more than maybe your average grocery store. Obviously, the grocery store probably wouldn't have any shares to push out, but you know what I'm saying. So a lesser worth of a building or a business. So the cost of one share is found by the company's worth divided by the number of shares that they have available to you. So you pay per one share. Investors hope to make money by investing in the companies they believe will succeed. So sometimes shares can be as cheap as like $5, and sometimes shares can be as expensive as like $5,000 or even more. It depends on the company's worth. You definitely don't want to buy low. So I had kids in class actually match these based on what they thought. So I'm actually going to, if you want to pause the video and try it yourself. So here are companies over here. You don't have to, but here are companies over here. And then let me match. What did I have the match somewhere. Hold on. And then how much it is per share. This is as of 2 days ago. So it's obviously, it changes by the second. So, but it's got to be close to it. So the one that surprised me, well, Amazon doesn't surprise me because, especially since the pandemic, this is how much it is a share, $3,203.08 per one share. Definitely don't want to buy an Amazon now. It's pretty much reached its peak. You want to buy low and hopes that something great will happen. So people who bought an Amazon maybe 2 years ago definitely are swimming in the money. 10 years ago even are swimming in the money right now because of the pandemic and how much people are like really leaning on Amazon. What surprised me the most was Chipotle. Chipotle is at $1,330 a share. Apple's also surprised me. I thought it would be a little bit more, but I guess Apple really hasn't come out with much besides like iPhones and stuff like that. Disney surprised me. I thought that would be a little bit more, but this also makes sense because with the pandemic, Disney hasn't really been active. So that's $172.40. PlayStation surprised me, but then I heard something was going on with their consoles. That was $40.50 a share. You may want to, that Disney actually might be something that, if you're interested, because the pandemic's starting to hopefully gear down, people are starting to go back and do stuff with Disney, which means they're probably going to come out with some good stuff. That might be something to invest in. I'm not sure. Nike right now is not doing well. Actually, the whole stock market's not really doing well, but Nike right now is not doing well. So that's at, I think they're down like 40%. This is at $133.66 a share, and then Target, that does not surprise me because Target is like a lot of people go there. That's at $225.09 a share. So it's constantly going up and constantly going down. You definitely don't want to sell when it's down, because then you'll be losing money. So that makes sense. Okay. Fun fact, Amazon stock closed at a record high in October of 2009 at $118 per share. So if you bought an 09 at $118 per share, now it's worth $3,200.03 per one share. Yeah, you make a lot of money. All right. I have to keep moving my face. When is the best time to buy shares? Well, predicting the movement of cost is very difficult. Ideally, you want to buy low in hopes that the company you're investing in will do well, obviously. If a share is low, chances are the company is either new or the company took some sort of hit. So you got to be careful. This can be risky because if a company is new, you don't know if the company will do well. You kind of have to put faith in the company will do well. Or if the company took a hit or they tanked, so you're hoping that they will recover somehow. So a lot of companies tanked in the pandemic. So if you have faith in that company that it's going to recover, definitely buy now. Example, Netflix. In 2011, I think even before that, they stopped using their DVDs, stopped pushing the DVDs out through the mail, and they lost. They said that we're going live stream. Everyone's like, what's live stream? No way, live stream's not a thing. Well, live stream was a thing, but a lot of people didn't believe in it. They lost 2 million customers, and their shares went down to as low as $7 a share. And people grabbed them. And now, today, it did spike even higher than today, but today it's at $500 a share. So yeah, they definitely had faith in Netflix that they were going to make a recovery, and they did, and they made a lot of money on that. So, all right, how do I do it? How do I even go about buying a stock? Okay, well, you got to get yourself a stockbroker. Oh, that's an online stockbroker, my bad. You have to get yourself a financial advisor or an online stockbroker. This person will guide you on what is best for you. They make a lot of money. They will also watch the market for you and pull your money and place your money where they see best fit based on data trends. They will ask you what type of plan you want. Now, there's a couple different plans. The low-risk diversification plan, which I'm in, that's like the 401k, the 403b, all that stuff. You have a basket of stocks from all different companies, and they hold them over a period of time. So I have them for my entire career. You don't worry about the daily ups and downs because there's ups and downs. Sometimes it's a big hit, and sometimes it's not such a big hit. If one company does bad, the others will compensate. So the others will kind of pull it back up. Your money will increase and decrease, but over time you will ultimately make money. Oh, my face. Medium risk is a few key stocks that you invest in. A little bit more risky because if one does bad, you feel it a little bit more. I'm up against the clock right now. Less companies in the basket, but you make more money quickly. And you feel that earning quickly. High risk are 1 or 2 main companies. You can make a ton of money fast, but you can lose a ton of money fast. So you got to be careful. Insider trading. If you don't know who this is Martha Stewart. She's huge in the home make your home wonderful world. She's all over the place. She did go to jail for insider trading, as well as many others for insider trading. Insider trading is when someone has information about a company that is unknown knowledge, and they use it, not known to the public, unknown public knowledge. And they use it for their personal benefit. So it's not known to the public yet. They know something's about to happen. If something big's about to go down, like they're about to sell their company or they're going to merge with another company, they tell their family and friends. If they're going to sell it, they tell them, pull your stock. Or if they're going to merge, they tell them, put money into this stock, because if they merge, they're going to make money. If they sell it, they're going to lose money. So they say, pull your stock or buy stock, because it's to their personal benefit. They get caught and they get convicted. They get arrested. It is illegal. And then they get put into a pretty little jail cell.